guys, it's Arielle here from Fix My Books to help you fix your book.
Hi guys, it's Ariel from Fix My Books, and today we're going to talk about salary versus dividend. So basically how to pull income out from your business to yourself personally. So this is a question I get from a lot of my clients. So I thought that I would make a video since I think that a lot of the people on YouTube would be encountering this same issue. So we're just gonna do a walkthrough quickly of the pros and cons of salaries versus dividends, and then in the end I'm gonna show you a rough calculation of how this all works out. Okay, first things first. A salary is a tax-deductible expense for your corporation or your business. It means it lowers your corporate tax payable. Dividends, on the other hand, are not a tax-deductible business expense. This actually comes out from retained earnings in the corporation. So this does not lower your corporate income tax payable. Another thing with salary is that it is more work because it requires regular payroll runs and tax remittances. So if you're a business owner, this would be, your monthly salary from the company compared to dividends, which is declared at year end. So you only have to do dividends once a year, while salary is a regular thing. It could be, twice a month, once a month, depends on how often you want to run it. But salary does take more work. A pro for salary is that it makes you eligible for a health spending account. Dividends, however, do not. Now, a health spending account turns your personal medical expenses into tax-deductible business expenses. I can talk about this more in length, or you can do your own research. There are different types of health spending accounts in Canada, otherwise known as an HSA, and this is one of the best ways to reduce your income taxes as a business owner. So if enough of you comment down below that you want to hear more about the health spending account, I might be able to do a video on that. So just let me know if you're interested in that as well. Okay, another pro for salary is that it actually adds to your RRSP contribution room since it's considered earned income. However, dividends do not. So dividends do not add to your RRSP contribution room. So if you're trying to build up your RRSP for retirement, I would say go with salary. Another thing with salaries is that it does have CPP benefits because it is run through payroll. You will actually have to pay twice the amount of the CPP as normal people do because you would be paying the employee and employer portion of the CPP. But again, this is basically just going into your retirement account. So that's one way to think about it. CPP is basically savings for retirement. So you do get that with salary, but you don't get it with dividends. Another benefit of having a salary is that income taxes are paid up front. It means that the business automatically takes the income taxes out of your salary before you even receive your net pay. That's a pro in my eyes, especially if you're not good at managing, money or like saving for taxes at the end of the year. Definitely go with the salary because then the payroll taxes are just going to be automatically remitted to the CRA. So you're not going to be hit with, a large tax bill at the end of the year that, you will have a hard time paying. So that's one benefit of having a salary. And the thing with dividends is that you have to pay the income taxes at year end. So if you, kept taking out dividends throughout the year, and then when it comes time to pay your personal income taxes, right? When you file, you suddenly see, oh no, you owe, 12 grand to the CRA and you don't have that money in savings, then you find yourself in a situation. So if you're not very responsible with saving money for income taxes, I would say just go with a salary. And also, if you owe more than $3,000 a year for the last 2 years and you take out dividends, the CRA may require you to pay quarterly tax installments, just because you owe them money at the end of the year. So just be aware of that may come with declaring dividends. Another pro for salaries, which you do not get with dividends, is that it adds to your proof of income. So if you want a mortgage or car loans or, personal loans, the salary would definitely be something that you would be able to show any of your creditors and they would take it as income. Dividends, however, since they're not sure if you're going to get the same amount of dividends each year, a lot of creditors may not accept dividends as proof of income. So if you're planning on buying a house, starting a family and all these other things, definitely go with the salary because you would need that to show proof of income. Another thing with the salary, it's not just proof of income for buying a house, but we'll get to that in the next slide, is that if you take a salary, because it is a salary and it is considered earned income, and you get RRSP contribution room, it works, it's basically a benefit in 2 ways. The first benefit is that since you get the RRSP contribution room, you can put money into your RRSP and lower your income taxes payable. And then when it comes time to basically buy your house, you can take out $35,000 from your RRSP tax-free if you pay it back within the 15-year period. So this just means you still get the tax benefits of lowering your income taxes by contributing to your RRSP, but also since you're taking the money out of your RRSP tax-free, that's basically another benefit. So even though you take the money out of your RRSP, that doesn't mean that you don't get the tax credits from contributing to your RRSP. So those are 2 great benefits to having a salary and then contributing to your RRSP. Dividends, however, since they are not considered earned income, it does not contribute to your RRSP contribution room, and therefore you will have less money to take out of your RRSP if you want to buy a house under the first-time home buyers plan. Okay, so I promised you guys that I would show you a calculation of how this all works out when you take out dividends or salary in a company. And so this is a made-up profit and loss statement. You can see that on one side it says dividends, on one side it says salary. Everything is the same in terms of the expenses, except one has payroll expenses, which is the salary. The other one does not, because this is the side for the dividends. So you can see here in the very end, the total expenses, there's way more expenses in the salary because of the wages and taxes over here. But again, the rest of the expenses and the income are exactly the same. So the net profit for the one with the dividends, because there is no salary, it's only dividends, is $103,000. And the net profit for the salary is only $20,000 because of the wages or salaries that's been added as an expense. So you can see that the profit is $103,000 and this one is $20,000. So the $103,000, the corporate income tax you're going to have to pay is $12,895. So I just use the online calculators for this, so it might not be exactly perfect, but it's going to be very close to what a real world, scenario would be in terms of this. So the corporate income tax is $12,000 and the corporate income tax of this is only $2,500. You might be asking why, and it's because since we declared $80,000 in payroll in the salary side, that lowers, and this is a tax deductible business expense, right? So that lowers the corporate income tax you're going to pay because you have less profit. Therefore, you're going to have to pay less taxes, right? However, since there's no payroll expenses here, since it's dividends, and dividends are not a tax-deductible business expense, as I said, it comes out of retained earnings, so it doesn't lower your corporate income tax payable. So you can see here it's 12,000 and this one is 2,500. It's around 13% of the profit before the income taxes, right? So you can see the corporate income after taxes is 90,000. This one is only 17,500 because again of the payroll expenses. Now, this is the part that most of you will be very curious about. It's the personal income tax you have to pay on dividends versus a salary at the same amount. So 80,000 is basically the average net income here in the average salary, here in Canada. So that's why I used this figure. So you can see that in 80,000 of dividends, you're going to have to pay $10,000 in personal income tax, and then you get 69,000 in after tax income. Now, when you get a salary, it's 80,000 in salary, you're going to have to pay 20,000 in personal income tax, and then your after tax income is around $59,671. If you think, oh yeah, I'm just going to go with the dividends because there's more, after tax income and I pay less personal taxes, you'd be correct that you would pay less personal taxes. But in the very end, it all balances out. You can see here, the corporate income tax is 12,000, which is this one over here. And the corporate income tax on the one that has a salary is 2,500. The personal taxes for the dividends is 10,000 and the personal taxes of the salary is 20,000. So all in all, you can see 22,970 versus 22,829. They're almost the same. So you might think that you're saving on personal income tax when you are declaring dividends, but you're going to pay way more in corporate income tax compared to personal tax. Now with salary, you're going to pay way more in personal income tax, but way less in corporate income tax. But again, the salary does come with a lot more benefits like the RRSP contribution room, proof of income if you want to get a mortgage, a personal loan, things like that. If you're renting, they will ask for your paycheck. That will obviously come with having a salary, as well as the health spending account. So if you're a person like me, I wear glasses, I have like prescription glasses and things like that. Those can all become tax deductible business expenses under a health spending account, which you are only eligible to get when you are under payroll as the business owner. So there are pros and cons of each. I talked about that a while ago, and I just wanted you guys to see, see all the numbers and how it all adds up in the end. So really, there's just no way you're going to get out of paying taxes one way or another. The government will take their share of your income, and whether or not you decide to do dividends or salary, you're going to pay almost the same amount of taxes. It really just depends on your personal tax situation as well as your plans in life. If you are planning on buying a home next year, I would suggest do a salary, get the RRSP contribution room, contribute to your RRSP so that once all the money is in your RRSP and you do decide to buy a house, you can take the money out tax-free and still get the RRSP deductions in your income. So it's really about where you are in your life and your personal tax situation when it comes to deciding the pros and cons of either having dividends or a salary. So if you have any questions, comment them down below. I'll be happy to answer them. If you guys want me to talk more about the health spending account, I would be happy to. Just let me know if you want me to go over what a health spending account is for businesses. So once again, this is Arielle from Fix My Books, helping you fix your books.
Hey guys, I hope you liked the video, and please don't forget to subscribe so you can tune in to the next videos in our tutorial series here on YouTube. And once again, this is Arielle from Fix My Books, and I'm here to help you fix your book.